US equity fund wrap up 2025 on a high as AI rally fuels investor confidence. The US equity funds ended 2025 with renewed momentum, attracting strong inflows for a second consecutive week as investors closed the year buoyed by an artificial intelligence-led market rally and growing optimism around corporate earnings. Data from LSEG Lipper shows that US equity funds recorded inflows of approximately $16.89 billion in the final week ending December 31, following $18.3 billion in the net investment the previous week. The back-to-back gain underscores sustained investor confidence as markets capped off another positive year. The rally was firmly reflected in benchmark indices. The S&P 500 advanced 16.39% in 2025, while the Nasdaq Composite surged 20.36%, driven largely by AI-related stocks. The Dow Jones Industrial Average gained 12.97%, marking the third straight year of gains across the three indices. Looking ahead, earning expectations are reinforcing bullish sentiment. LSEG data covering nearly 2,800 US large and mid-cap companies indicates that analysts now forecast earning growth of about 15.13% in 2026, up from an earlier estimate of 12.92% for 2025, an upward revision that reflects improving profit outlooks. Investor preferences within equities, however, were selective. Large cap equity fund drew $16.87 billion in net inflows during the latest week, though this marked a slowdown from the hefty $37.4 billion added a week earlier. In contrast, small cap and mid cap funds saw outflows of $1.42 billion and $269 million respectively, suggesting a tilt toward perceived stability over risk. Sector focused funds recorded modest net outflows of $116 million, with healthcare and financial sector funds leading the declines, shedding $502 million and $290 million. The pullback hints at cautious positioning as investors rebalance portfolios after a strong year. Meanwhile, bond funds moved in opposite direction after enjoying 12 consecutive weeks of inflows. US bond funds saw $2.09 billion withdrawn. Short to intermediate government and treasury funds accounted for most of the decline, with $5.43 billion pulled out, reversing a substantial inflow from the prior week. Still, demand remained resilient for certain fixed income segments as domestic taxable bond funds and short to intermediate investment grade funds attracted $1.17 billion and $920 million respectively. As 2025 draws to a close, the data paints a picture of investors entering the new year with confidence favoring large cap equities, recalibrating bond exposure, and betting that the AI driven growth story will continue to shape US markets in 2026.